Hey everybody, Marty Missouri, good evening. October 25th, 2018. Just want to bring you up to date on the present state of the market, looking at very simple technical indicators here. If you've been with me the last week or so, it was a week ago yesterday that we did the first video using this chart. This is the on balance volume indicator. Line will move in the direction of the move itself from the open to the close. So again, I was showing you here very early on that the volume look was not inspiring and suggested that even when we were right here that a test was very likely. So tested this low that was established back here on the 10th or the 11th and passed it, and then had that big down day yesterday, essentially failing the test because it closed here, establishing a new low. And then we had the big rally today. So now what we actually need to do is move this down because we've established a new low in this almost correction phase. I think the S&P was down about 9%. This is the Dow, and it was down just about that much as well. So here we have this nice bounce. And so what is the volume indicator suggest to us in terms of, is this the kind of bounce that would lead to some momentum and perhaps new highs in the relatively near future? Well, it wasn't big from a volume day standpoint. It looks very much like this update here. Now, again, I like this indicator a lot. It's very simple, easy to understand, and it makes some sense to me. However, it doesn't always paint the correct picture on a day-to-day basis. The thing we haven't done yet is actually clicked into the day to see really what the character of the volume was during the trading day. And I want to do that for you, showing you today and comparing it to yesterday. Here is today's nice 400-point up move in the Dow. And here's today's on-balance volume indicator. So you can see as the market took off in the morning, you got good confirmation that the buyers were really coming in with some aggressiveness and pushing shares higher. The upticks on the 1-minute chart had the biggest volume. Here though, you see the market kind of tailing off a little bit, kind of a flat move from here to here, but notice the on-balance volume actually sloped down. We had what's called a short-term bearish divergence, which means the down minutes, the down ticks in here actually were met with more volume than the upticks. And then we had the market kind of surge back and something less than inspiring volume. And then at the end, even before the market rolled over a bit toward the end, the volume indicator was telling us that sellers are coming in with aggressive sell orders, and then we really tailed off toward the end. So you come to this point where the volume kind of peaked. Here the market actually moved higher, but actually volume didn't. So we had a real bearish divergence. So unfortunately, today did not feel like an aggressive, strong, lots of money coming in to move the market noticeably higher with some momentum. Contrast that with yesterday. Yesterday we had that big 600-point down day, and we had the volume pretty much matched it the whole way. So again, right now, folks, sellers pretty much own this market. At least that's what my volume indicators suggest here. So like I said in yesterday's blog post as well, there were other technical factors that just didn't really tell us that this was kind of that blowout capitulation. Now that doesn't have to happen every time, but it's pretty common that when you get the kind of downdrafts that really get your attention, a couple thousand points in the Dow, 8, 10, 12, 15%, typically that's the kind of thing that needs a washout. The smart money is just kind of waiting for that to happen before it really goes in with big money, with big volume to push us up to the next all-time high. Now, folks, we do all this to kind of help you put all this into perspective. In my world, in our world, the way we view this volatility is that really for the patient long-term investor, as much as nobody likes to see values come down, this would be volatility to, for the most part, ignore. Now for clients, we're doing some tweaking along the edges. It's a portfolio by portfolio thing. If we think there's a little too much technology in the portfolio, we're going to pare that back to get closer to our targets, for example, among other things. But we're not abandoning our growthy stance at this point because general conditions dictate that we remain growthy. Regular readers and clients know what my concerns are, and there's a number of them, but the big one, of course, is the trade war. I don't see how this market can get back to sustainable highs amid the concerns that we're hearing in the earnings outlooks. The issue is not the Fed. The economy is strong enough, and it gives the Fed the opportunity to put itself in a position to do battle with the next recession. Right now, we have essentially a 2.25% target Fed funds rate. You adjust that with inflation, and you have zero interest rate still. Over the last 50 years, when the Fed was in stimulus mode during recessions, on average, they moved interest rates down 500 to 600 basis points, or 5 to 6%. Where obviously, if we're only at 2.25%, if a recession were to begin anytime soon, the Fed has very little to work with, at least with that particular tool. They're going to have to get much more creative and find other ways to provide monetary stimulus if indeed we have a recession anytime soon. Therefore, when we don't have a recession looming and we have some acceleration and we're seeing some inflation, that's the time to raise interest rates a bit to kind of keep inflation at bay, while at the same time putting themselves in a position to actually stimulate the economy when, it's not an if, when we ultimately roll over into the next recession. Once again, that's not what conditions are telling us is looming at this point. When I look under the surface, when I look at things like copper prices, when I look at emerging market currencies, which have actually begun to move up, which is very interesting. When I look at things, Baltic Dry Index, which prices the shipping of raw materials across the ocean, says the emerging market undertone actually has some bullishness to it. If the market, if the smart money, if the world really thought that this trade war was going to be a protracted affair and something much messier than it already is, these signals would not be given. It doesn't mean they're right, but it tells me that under the surface there is activity and there is the allocation of capital to areas that it wouldn't go if it was convinced that we have real problems with trade going forward. What it says is right now it's making a bet that cooler heads will prevail and we'll put an end to the strategy or whatever you want to call it before things roll over and we have to start accommodating the next recession. In the near term, expect more of this, what feels like extreme volatility, and expect that there's some more downside action to come. If you're a patient long-term investor, under these circumstances, you do not react to it. Thank you as always for watching and listening, and I'll talk to you again very soon. Bye-bye.